what are the different types of commercial banks. Okay, so the first type is public sector bank. Public sector banks are those types of banks where government has more than 50% of ownership. Okay, when the ownership of government in those banks have more than 50%. So what are the different banks if we have to count? SBI, Bank of Baroda, that is known as BOB, UCO, Union Bank, etc. Okay, so these are the few public sector bank where the ownership is more than 50% by government. It is regulated, supervised and maintained by the government entities. Let's go to the next one, that is private sector bank. Private sector banks are fully owned by private bodies. Okay, so when private bodies are owning a bank, it comes under private sector bank. Government doesn't have any ownership in it. It is managed and controlled by the private bodies. It is regulated by RBI finally. Okay, so if we have to name few private sector bank, we have ICICI, SDFC, Axis, right? These are the few highlighted private sector banks. Let's go to the next one, that is foreign banks. Foreign banks are those banks who have their main branch or headquarter in some foreign country, but they are operating in every possible country outside their region. Okay, who have their headquarter, or the host branch at foreign okay, but they are operating domestic. If we have to name few foreign banks, we have HSBC, Standard Chartered, okay, Citibank, etc. Okay, so they have their headquarters somewhere, but they are operating in India as well. And the last one here we have is Regional Rural Bank. It is also known as RRB. Okay, these are also known as RRBs. Okay, what's the purpose of now regional bank when we have public sector bank, private bank? What's the need of regional bank? Because these public and private sector bank, to have their facilities provided to everyone is still not that possible. That is why regional rural banks are formed. Okay, the main purpose of regional rural banks is financial inclusion. Okay, now we know what is financial inclusion, where we make sure every person gets the banking facility. Okay, so regional rural banks make sure that these banking facilities are available to every person. So these rural banks mainly help the farmers, artisans, people who are linked to small micro industries, okay, or agriculture. So these people are benefited by the regional rural banks. As the word regional, they are mainly inclined to a particular region and they cater to that particular region's needs. Okay, so these are the major four types of bank under commercial bank. So we have studied about what are commercial banks, we studied about what are the features of it, and we learned about its functions and types. So with this, our commercial banks are over. So now we are going to learn about monetary policy. Now let's see what is monetary policy. Okay, it refers to the process by which the central bank, that is RBI, manages the supply of money. Okay, mainly we need to know one thing first. Whenever we talk about monetary policy, it has to be RBI who plays the major role. Okay, the monetary policy is given and guided by RBI in our country, India. Okay, so it is a process. Okay, monetary policy is a process where RBI use few tools. They are using few tools to do what? To manage the supply of money. Means how much money should float in the market, how much money should flow in our country. It is decided by whom? RBI. They manage the supply of money. Okay, they manage the interest rates prevailing in the market. Now banks can charge any amount of interest if they think so, but no, they cannot do it because it is regulated under the monetary policy given by RBI. So RBI also manages the interest rates prevailing in the market for both, for deposits as well as for the loans as well, and the credit availability to influence the economy. And they also, and how much credit is available which can influence the economy. So this is what is defined as monetary policy. So it is a process using tools to do three things. Okay, managing supply of money, managing the interest rates as well as credit availability. The policy aims to control inflation, stabilize currency and foster economic growth. What is the main function this policy? It aims to control inflation. The main purpose of having a monetary policy is to control the inflation. Okay, now let's understand that how this monetary policy is able to do the inflation management. Okay, so let's understand what is inflation. We know inflation as when the prices of things go up. Okay, when the prices of the things go up and we are unable to buy things. Okay, when we don't have proper purchasing power, when we don't have what? When we don't have purchasing power. Means our money is not sufficient for us to buy something. That scenario is known as inflation. Okay. So what happens? Our inflation in our country is supposed to stay between 2% to 6%. Okay. Something in between is ideal state of our country. It's not inflated, it's not deflated. It's an ideal condition. Something, if we have an inflation between 2% to 6%. Okay. If we have more than 6%, then what happens? In this state, what happens? That people have a lot of money in hand. Okay. People have a lot of money in hand. And when you have a lot of money in hand, what you feel like? You feel like buying everything which whatever you can afford. You won't feel like buying a car, you want to buy a house, you want to have a vacation, right? So you want everything when you have money in your hand. So just imagine if everyone has money in hand and they all started demanding things. Okay, I'm giving you one example. Let's say there are only 100 cars. There are only 100 cars and there are 1000 people who want to buy it. Okay, there are 1000 people who want to buy it. So, can this 100 car can be sold to 1000 people? Not possible. That means now this car company knows the cars are in high demand. And when demand is high, the prices are going to go high. So what he will do? He will increase the price of the car. That whoever is ready to pay more amount will get the car. Okay. So what happened? The price of car has increased, which shows the inflation. Then people will start telling, now we can't afford the car because we don't have the purchasing power. It shows the inflation, right? And when it happens, the things around us, the price start going up, people cannot afford things, right? So at that time, now this monetary policy keeps a tab. So what RBI does? RBI start pulling money from the public. Okay. So how it is done? It is done through banks. RBI is going to guide the banks, telling them make the loans costlier. Means make the loans costlier by increasing the interest rate. Okay. If currently you are charging 8%, increase it to 10 or 12%. So people will feel that taking a loan is a costly affair because you have to pay more interest. So when they will stop taking loans, they don't have money in hand. If they don't have money, they will stop demanding. When they are stopping demanding, the prices will fall down to again get into the bracket. Okay. So this is how they control the inflation. Okay. In rarest of condition, if the inflation goes below 2%, at that time RBI is going to guide banks to give more loans, because that means people doesn't have money in hand. That is why they are not demanding anything. Okay. We have products but nobody to buy. So they will start floating money in the economy. They will start asking banks to grant more loans by lowering down the interest rates. So by doing this, they are controlling the inflation in the country. They stabilize the currency. Okay. Next thing which they do, they stabilize the currency. Means the when we want to go and exchange our funds, I mean our money, our rupee with some other currency, we know that how much it is fluctuating, right? We have to give more rupees to get a dollar, right? That means our currency is not stabilized. It is always fluctuating. Okay. To stabilize it, to have a more stability in our currency, RBI provides monetary policy. Then when these are done, they foster economic growth. When RBI is able to achieve, they control the inflation, also they stabilize the currency. The third thing they want to achieve is foster economic growth. They contribute towards the growth of our economy. When economy is also growing, our currency is stabilized, we have controlled inflation, then of course we can achieve full employment. Okay. We can achieve more and more employment in our country, where people are getting employed and earning money. So I hope you have understood what monetary policy is. Now let's learn about what are the objective of monetary policy in India. What RBI wants to aim when they have proper monetary policy in the country. So the first one, it helps in controlling inflation. We understood just now that how this inflation is controlled. It RBI makes sure the inflation stays between 2% to 6%. And do you know what is our current inflation rate? It is 6.50. That means we are just 0.5% more than the inflation rate. Means RBI currently might be having a lot of tools applied to get it back between the range. Okay. So one of the important objective of having monetary policy is to control the inflation. Second, promote economic growth by facilitating to development of its infrastructure, to development of its trade. Okay. Trade, commerce. Okay. So all these are led to growth if we have proper monetary policy, because there will be a proper flow of funds in the market which can lead to growth of economy. Then stabilize the currency. Okay. So RBI makes sure the currency is stabilized. We are not having the value of our rupee should not go down in comparison to other currencies around. Okay. It should hold a lot of value. Means when we go outside the country, the amount of rupees we are exchanging, it should gain a lot of value to us instead of less. Not only when we are going outside, but in case of trading also, in exports and imports, this stabilizing the currency plays a very vital role because we are exchanging funds over there. Then generate employment. So when we have a lot of funds flown in the market, okay, a lot of funds are flowing in the economy or in the market, that means people have sufficient funds to facilitate the businesses to start new organization. When new businesses, new organizations are coming up, it is leading to more employment. Okay, a proper or a sufficient flow of funds in the economy helps in generating more employment because it leads to more entrepreneurship. Okay, it leads to more entrepreneurship. When more people are starting business, more employment they are going to generate. Encourage financial stability. So monetary policy makes sure there is a financial stability in the economy or in country. If we have loans on us, we are able to pay it. If when we have proper stability of funds, probably we don't need more loans from other banks or World Bank to facilitate to our country or its development. Okay, to have a proper financial stability where our deposits and our lending have a balance. Okay, then promote balance of payment stability. Balance of payment stability comes from our exports and imports. That how much, what value of products, goods or services we are sending out or we are receiving. So the flow of funds, how much funds we are giving, how much funds we are receiving. So when we compare these two, either we are going to get deficit or surplus. Okay. So it promotes a proper balance of payments, means neither we are giving a lot of funds or we are receiving a lot of funds. Okay, because both the cases have its own demerit for the economy. So it makes sure we have a proper balance between inflow and outflow of fund from our country. Okay, then next we have control credit flow. That what is a proper credit flow? We have monetary policy regulates it. Why it is needed to be regulated? So that a particular industry should not get all the benefits. Okay, let's say there are 4 industries we have. Okay, one industry is highly profitable. So all the banks want to give loans to them. What about these three who also need to grow? Okay, because these are less profitable, banks are not focusing on it. So what will happen? That one particular industry is going to grow and these three on which our economy depends is not growing much. So they control the credit flow so that it can facility of this credit to every possible industry and person so that everyone can grow, because our economy doesn't depend on one industry or one person, it depends on all together.